What's going on, everyone, and welcome back to another video. So in this video, I want to talk about the most recent project that I'm working on right now, which was the 6-unit apartment complex that I recently just closed on about 2 weeks ago. So if you haven't seen that first part 1 video, make sure to go check that out. I posted that about 1 week ago. So that's a good place to start. That kind of just gives you a good overview of the entire deal, from how I found it, kind of what my plans are with it, and the potential that I see with it. But in this video today, I want to talk about more so the numbers on the deal. So I want to talk about a little bit more about what the purchase price was, what the down payment was, how much money I needed to put down. And then I wanted to talk about what the returns are looking like currently with the current market rents. And then I want to talk about what I expect the returns to look like in the next year, maybe 18 months, as I stabilize this asset and get the market's rent rates up to where they should be. So what I'm going to do is I'm just going to jump into my phone. So there's this calculator that I use a lot for a lot of these different types of investment. It's called the CDS rental calculator. So if you aren't aware, there is someone else on YouTube. His name's Chandler David Smith, and he has over, I think, 200 rental units right now. And I have gotten a lot of my knowledge in real estate from this gentleman, and he has his own calculator, and this is actually the one that he made, and it's really good because it breaks down, you can just put all of your numbers into the property, what the purchase price is going to be, what the down payment's going to be, what the amortization schedule looks like, the interest rate, all that. And then it kind of spits out a number of what the cash on cash return is. And like I mentioned in my first video, cash on cash return is one of the most important indicators for me before I invest any of my hard-earned money into these different types of assets. Obviously, there's a lot more analysis that I do on my own before I, buy these different types of assets. But this is a good overview of just a really quick, you can just kind of throw it in when you're analyzing these different types of deals to kind of get an idea of what the return is going to be. And then you want to dive in a little bit more as to what the market rents are in the area. And then, of course, what the asset is actually going to be bringing you in regards to how new it is, is there a lot of repairs that need to be done, all that kind of stuff. So what I'm going to do is I'm going to jump into my screen here. I'm just going to screen record this on my phone, and I'm going to talk you through a little bit as to kind of what I originally saw and what I'm expecting to see. So right now we are in my phone, and you can see here the purchase price is $725,000. The down payment is 20% for this property. So a lot of commercial properties, you see people out there saying that you need 30% down. I was able to find a lender where I only had to put 20% down, which was huge for me because it's less money that I needed to bring out of my pocket. So you can see that the down payment for this is $145,000. This deal was a little bit weird because when it was appraised, obviously I bought it for $720, but they brought $5,000 in seller concession. So really, realistically, I have $725 in there, but I actually bought it for $720. When they did the appraisal, it actually only got appraised for $714,000, but the other $6,000 was for everything that kind of came with the property, like the stoves, the dishwashers, the refrigerators, all that kind of added up to $6,000. But the bank was only able to lend me 80% of the value of the actual asset. So they weren't actually able to lend me on that $6,000 for the stove and all that kind of stuff. So I had to bring a little bit more down because they were only able to lend 80% of $714,000, not $720,000. Hopefully that makes sense for you guys. But this still gives you a good idea of generally how much money I needed to bring to the table. The amortization schedule for this loan is 20 years. The interest rate is 4.3%. It has a 7-year balloon, so it's 20-year end, but a 7-year balloon. So that means after 7 years, I have to either go back to the bank, refinance, or I have to pay the mortgage off at the time and sell the property or do something with it. So just kind of keep that in mind. The current rents are $5,310 a month. Vacancy, I like to just have this in here just to be a little bit conservative. I do 6% of the gross rent rate. So 6% of $5,300 is around $3,800 a year that I'm putting aside towards possible vacancies of these properties or of these units. I have 8% towards maintenance, which is about $5,000 a year and that could be for snowplow, for lawn maintenance, for something that breaks in one of the units, whatever that may be. about $5,000 set aside for that as well. Insurance, I have $3,000 a year insurance policy, and the taxes, this is the huge tax save for me because this has a 15-year tax abatement, another 7 years left on this tax abatement. So I only have to pay around $2,200 a year in taxes, which is absolutely absurd for a property of this size. So when I do all this and I say run numbers, you can see the cash on cash return for this is 4.57%, which isn't that great. Like I mentioned in my previous video, I like to kind of shoot for around 10% cash on cash return, somewhere in that ballpark. But I like to first do it what it currently is in the current market rents, and then I like to do it again for what I expect it to be once I increase the rents to where they should be. So you can see the cash on cash return is 4.57%. The cash flow is $6,600 a year. The principal pay down, since it is a 20-year AM, I'm paying a lot of principal very quickly, $18,700 a year. So you can see the total return on investment is 17.47% each and every single year when you add the cash on cash return and also the principal pay down. So if I go back to edit and I go back to the rent section and I increase this to $6,000, that is, what I expect it to be in the next 12 to 18 months once I kind of bump the rents up a little bit. I keep everything else the same. The maintenance is the same. That's on the gross. So the maintenance actually goes up a few $100, and also does the vacancy. I keep everything else the same: insurance, taxes, the down payment, the years to pay off, the interest rate, and I click run numbers again. You can see the cash on cash return now is 9.5%, so much better. The cash flow is $13,781 a year. Principal pay down stays the same, and you can see the total return on investment is 22.41%. So this is just one way that I like to analyze all my numbers when investing in these different types of properties. It's a very simple process that I like to just kind of do. I like to do this at the start, and then I break it down a little bit more in regards to what actually the market rents are, and realistically what I can raise them to. And then you can get quotes on insurance policies. Typically, I like to use either $2,500 to $3,000 a year, and that's pretty realistic. Pretty realistic for a property of this size. And then taxes, obviously you have to do some research on that as well. So that's just a quick update. I wanted to break that down for you a little bit, just to kind of give you an overview of what the numbers look like for a 6-unit deal of this size. And if it is realistic for something like you guys to go out and find a deal like this. And you don't have to do it at this scale. You could do the same exact numbers when you're buying a duplex, maybe, and you're house hacking and you're living in one of the units, you're renting out the other units, and you can really see what the returns are going to be. And even I always like to say this, even if you're only putting 3.5% to 5% down, I still like to run my numbers with a minimum of 20% down payment, even if I'm not bringing 20% to the table, because if you bring less, obviously your cash on cash return is going to be a lot higher. But when you run it with a 20% down payment, that kind of gives you an overview of if the cash on cash return is actually going to be good and if it's actually a good deal, because the lower it is, the higher cash on cash return is going to be. So if you're kind of getting around that 10% cash on cash return for a 20% down payment, that just tells you that it is a good deal. And the lower you bring, the more return you're just going to have. So if you guys did enjoy this video, make sure to like it. Also, if you aren't subscribed to this channel yet, make sure to hit that subscribe button down below. I'm going to be posting a lot more content in regards to this property and also some other things that I have going on in the works right now in the real estate market. So if that is something that interests you, make sure to hit that subscribe button. Make sure to like and share this video if you found some value. But that's all I have for you today. I hope to see you guys in the next one. Take it easy.